Our next guest says he now sees a greater than 60% chance of U.S. recession beginning this spring. Joining us here at Post 9 is JPMorgan Asset Management Chief Global Strategist David Kelly. There will be blood was the title of one report last night.
Yes, from our investment bank. I mean, I want to make it clear. I think that there is at least a 60% chance of recession if these tariffs stick. And I know, one scenario is that different countries try to negotiate them down. An even better scenario, of course, for markets would be if the president decided to postpone the implementation of reciprocal tariffs while he goes country by country and thinks about it. Because if we got a tweet, in the next, at any point, which said, OK, we're going to go back to 10% across the board, and we're going to look country by country at reciprocal for whatever reason. If we saw that, then I think the markets would recover. 10%'s not good. By any means. Tariffs generally tend to slow the global economy and hurt the market, but it's a whole lot better than what we're looking at right now.
You're kind of mind melding with Lloyd Blankfein, who tweeted a moment ago, as we said, make the 10% minimum tariff immediate, but defer the reciprocal part 6 months. Take the win. President said he'd make us tired of winning. I'm there now, is what Lloyd argues.
Yeah, they're very sensible. And then if you go through, I mean, tariffs are bad, so there's nothing wrong with saying that Europe needs to get rid of its tariffs. The best reciprocal tariffs are 0-0. Absolutely, and really we should not be using tariffs as a revenue source. It's the most destructive of taxes. There are other ways of raising money. Tariffs are really the worst way to raise money.
But they have framed it as a revenue engine.
Yes, unfortunately they have. But the problem is, first of all, it's a very regressive tax. Tariffs, even more than the sales tax, the poor and lower income households pay a greater percentage of tariff taxes than say, income taxes. So that's one thing. But second of all, it just slows down productivity. It slows down global commerce. I mean, the United States can so flourish. We're the best in the world when it comes to competing and free enterprise. Why not take advantage of that? And I feel like I'm echoing something that Milton Friedman or Ronald Reagan would have said. I feel like this is the most conservative viewpoint you could take, is let's flourish under free enterprise. That's what we should be doing.
But you know that President Trump channeled, I think, a lot of frustration, particularly in the industrial Midwest, where jobs have left and manufacturing share has gone to China.
Yes.
He campaigned on it. And I think that he's there, and he feels he has survived 2 assassination attempts in order to do this and level the playing field.
But it's so important to understand what actually causes our trade deficit. You've got to get the pretext right. There are 2 things causing our trade deficit. One, for years, we've supported the idea of we want a strong dollar. Why do you want a strong dollar? I mean, the dollar is not our national flag. You fly the stars and stripes as high as possible, but the dollar should be at an appropriate level for your economy. The dollar's been too high, and second of all, we run a big budget deficit. And it is a mathematical certainty that if the private sector is balanced and the government spends beyond its means, then the country will import more than it exports.
Yes,
You'll have a budget.
The logic, is not rooted in economics.
But if that is what is causing the problem, then address those 2 things. I fully support the administration's view that we ought to bring the dollar down. We should bring the dollar down, and we should bring down other people's trade restrictions. And I think we have the bargaining power to do that. But please don't put tariffs, build walls on global trade, because that actually slows everything down and makes people poorer.
So how do you think the Europeans think about this?
Well, they're very angry, but they are being careful they don't want to harm their own economy, because one of the odd things is that even if somebody puts a tariff on you, actually the optimal strategy is probably not to put a tariff back on them, because you're only hurting yourself twice. A tariff hurts the person who puts it on, but also as well as the person.
That's what China did.
Well, yes, but I think China is trying to, just trying to play tough here and try to really force the U.S. to capitulate here. But really, we don't, we need to have trade partners, not trade adversaries.
So, I mean, President doesn't agree with you. So what should you do as an investor?
Well, I think, first of all, you should recognize that policy will change. Markets matter, economies matter, elections matter. And I think that it's quite possible that policy will change. The second thing is, and this is true regardless of this event or any other event, look to valuations. When you never know the hour nor the day of a bear market, but you know eventually there's going to be one. But what you do know is where it's going to be concentrated. It's going to be concentrated in the stuff that are the most hype and euphoria and speculation in it beforehand. And we're seeing that with the Mag 7 coming down, with crypto coming down. So you want to just look at valuations and be very diversified in a sophisticated way.